If you're thinking about the checklist of why you would not make investment decisions, one of them would be policy uncertainty. And I think that's helpfully now reducing.
I think it's really important to remind people what Thomas has just outlined really, really clearly is a competitive disadvantage for UK companies looking to scale, to grow, to be acquisitive, to be more productive, because they haven't got a continuum of capital. I would abolish the OBR, the Office of Budget Responsibility, but, you knew there's a but because I'm an economist, you have to do it from a position of strength.
Earlier today, November the 27th, 2025, I had the good fortune of talking with friend of the pod, Simon French, Head of Research at Panmure Liberum, and Thomas Moore, Senior Investment Director at Aberdeen, to discuss yesterday's UK budget and its implications. Simon, who writes a regular column in The Times, is a go-to person on the UK economy, and Thomas is steeped in experience and understanding of the value and income attractions of UK equities, with a long and successful track record managing the Aberdeen Equity Income Trust. We had a great chat and distinguished the important differences between the UK economy and the UK stock market. But also, at the risk of mansplaining, they also identified what more needs to be done for the UK economy to deliver growth and, importantly, to make UK assets more attractive to global capital. But of course, none of what you are about to hear is any kind of advice, but just for your information and hopefully entertainment. Please take personal financial advice before investing a penny of your money into these crazy markets. And with that said, please enjoy my conversation with Simon French and Thomas Moore.
Brought to you by Progressive Equity.
So, guys, thank you so much for joining me. And Simon, thank you and Panmure Liberum for hosting this in-person conversation. It's a great honour to be here. Can we just start with the events of yesterday and how they changed the outlook for the UK economy?
So I think three elements to the changing outlook. The one that hasn't changed really is the growth outlook. The UK economy has seen growth momentum slow since the start of the year, and there's nothing really in the budget that changes that pathway over the next few years. We see growth still below its long-term trend between 1 and 1.5%, really out over the next 2-3 years, and there was nothing really to stimulate that in the budget. Where it's more encouraging, perhaps, is on the near-term inflationary picture, and I have to give the Chancellor credit that she perhaps learned the lesson of last year's budget of being quite an inflationary budget through the employer national insurance changes, hasn't repeated the mistake. And this does perhaps open up a pathway for the Bank of England to cut interest rates next month in December and perhaps again in the first quarter of next year. But if you're thinking about the consumer economy feeling a bit more optimistic, then that could be one of the catalysts. And the final one, and I'm sure we'll come on to many of the criticisms of this budget, and we've got plenty to pick over. But another thing that I think deserves a little bit of praise and may have an economic benefit is I think we can all agree around this table that the circus of the last 2.5 months has been damaging for consumer sentiment, business investment, and she did commit yesterday to a single binding fiscal event each year rather than two, and she increased her headroom from £9.9 billion to almost £22 billion. Both of those things should reduce both the frequency and the amplitude of future circuses, if that is the plural of circus.
So I suppose the ultimate clown show yesterday was the OBR release of the budget before she got up to speak. But maybe we can come back and talk about that and maybe turn to you, Thomas, to just give us your overview of how this impacts your view of the UK equity market.
Well, the UK equity market is fortunately not entirely driven by policy, because if it was, I don't think we'd be at around 9 or 10,000 on the FTSE 100 at the moment. So I think there is a clear difference because of the geographical weighting. Now, that's well known. So about 80% of geographical revenues come from outside of the UK. If you look at the underlying sales breakdown of each company and then aggregate that, that's the starting point for a conversation about UK equities. Now, we're here to talk about the budget because that's what's relevant today. And I would say long term, the thrust is still worrying that we have, putting it in terms of Winston Churchill, it's not quite the predatory tiger that needs to be shot, but it's certainly the cash cow that's being milked. And the UK economy is not being seen as a horse that pulls the cart strongly, as it would be if we had policy that was supportive, genuinely trying to nurture business. And I think we hear that played back to us in our company meetings with management teams when they let their guard down. And I think they've all felt extremely disappointed with policies so far since July 2024. Clearly, there's a lot of regret among the people who signed that letter of support for Rachel Reeves. Yesterday, the budget was not quite as bad as people had been fearing. So I think there has been a relief rally in FTSE 250 companies, the domestic companies. But sector by sector, I would say it's more that there have been an absence of new negatives and hence the relief rally rather than a whole set of new positives.
I've been saying for the last few weeks that given the volume of kite flying that we've seen in recent weeks, it's almost unimaginable that she could have said anything that hadn't already been raked over 100 times yesterday. So I guess that was almost inevitable that everyone's come away going, or at least that's over. It's sort of a lesson in expectation management. But to your point, Simon, on the impact on inflation and the impact on rates, I think there's two aspects to it, isn't there? There's the calculation of the creditworthiness of the UK and there's the political risk. But it did seem to me like it was a budget aimed at two constituents. There's her backbenchers who cheered wildly on the two-child benefit cap issue, and gilt investors. And there was a bit of a boost there.
There was, and I think that's absolutely the right lens to look through yesterday, which was many of the comments the Chancellor has made over the last 2.5 months were ill-advised, but the one that I thought was more sensible was the day before the budget, earlier this week, where she said, this is not a pick and mix budget. She was speaking directly to her backbenchers, if you like, learning the lessons or reflecting the scars of the summer, where they picked off welfare reforms to the winter fuel payment and to the personal independence payment. And despite a 150-seat majority in the House, there wasn't a governing majority for those changes. And having got a taste for rebellion, she clearly felt that there was a risk that they would pick over this finance bill that is coming, taking out the first stuff that they didn't like and just keeping the ones they do. So I think the two-child benefit cap was an attempt to buy inner party support. The bond market is slightly different, very different constituency of individuals, but clearly welcomed yesterday a couple of things. First of all, the gap that needed to be bridged was somewhat smaller than consensus, partly because the OBR sort of gave with one hand and took away with the other on the productivity assumption. We can come into that in detail if you wanted to. But also the inflationary picture that I mentioned at the very outset was better for the next 12 months, for into 2026. I think the big criticism I have had on the whole package is it does nothing, and this speaks to Thomas's point around the perception of UK domestic assets, almost all of them, debt, equity, our currency, gilt yields, have a very obvious inflation premium. UK inflation over the last 18 years has averaged 3%. The target, I don't need to remind you guys, is 2%. Obviously, some of the blame has to be accorded to the Bank of England on that, who ultimately have the target to keep inflation at 2%. I think at least as much blame, and I would argue more, goes to successive governments for making the supply side of the UK economy more sclerotic. Energy market, the jobs market, trade, areas where we used to be dynamic, areas where we used to be quite flexible, and therefore prices respond, supply responds, and passes on good economic value to consumers, that has become steadily more sclerotic. And there was very little yesterday to suggest a reverse journey is imminent.
She showed some signs, I would say, of understanding what the supply side of the economy is, but she shied away from any significant moves in that direction, particularly of things like the North Sea.
You're absolutely right that on areas like the Nuclear Regulatory Task Force, where actually warm words surrounding taking all those recommendations to try and reducing the cost of allocating capital to nuclear, which is the most expensive in the world, recognises the sclerotic side of regulation on deploying new energy in nuclear, but the politics appear to make that not acceptable in terms of the North Sea oil and gas. Similarly, in terms of major project approvals, Heathrow, Gatwick, positive noises on the Oxford-Cambridge Arc, and yet, in other areas, on house building, still an inability to make those difficult trade-offs on deregulating the private rented sector, environmental standards, nutrient tests. Everything we hear from house builders, and I'd be interested to hear what Thomas has to say about the publicly listed house builders, what they're saying. Lots of warm words about supply-side reform, but look at housing starts. They've gone in the opposite direction, suggests that the two hands don't know what they're doing.
And again, as you say, like whether it's the new runway at Heathrow or nuclear power, these are things that are a long way into the distance. There are some things that can be done today that she missed. So I guess the question for you, Thomas, on this is you've been on the record as saying that you have shifted your strategy, which is obviously a UK equity constrained strategy, to the non-domestic sector. You've increased your exposure, your relative exposure to the overseas earners. Is there anything that you've seen, or what is it that you want to see further to make the adjustment back? And I guess we can come on and now talk more widely about how we make, on the back of what we've seen here, the UK assets more attractive to global capital.
I'd say it's a nuanced answer to that. Firstly, valuation matters. So there isn't a lot of good news priced into UK domestic stocks. And I think I would be the first one to admit, as an investor who puts valuation at the core of my process, I'm raring to go in terms of increasing my exposure to small and mid-cap domestic stocks. The domestic stocks I currently have in the portfolio are largely non-discretionary stocks. So, for example, Galliford Try is in my top 10. So it's benefiting from massive investment in water. Balfour Beatty is heavy investment in power. So these are things that are going to happen regardless of how good or bad policy is. We need that investment. And so that will happen as a matter of course. And by the way, customers will see that in their bills. All this inflationary talk is real. It's regressive as well, by the way, and that's why arrears are going up. So therein lies the problem. A lot of work needs to be done to fix the UK, and somebody's going to have to pick up the tab. And the backbenchers need a bit of education on how bond markets work. And if they listen to Simon a bit more, maybe they would learn. And I think you're going to put some time in your diary to speak to some of these MPs in the coming months, Simon. Well done you, because that's what we need. We need people to be joined up. I mean, we're coming at this as a country in such a schizophrenic way. So going back to the portfolio, look, what I need to see is further evidence that the top level of government, there is an understanding that this liberalisation of policy can be a good thing, rather than the continual placing barriers, placing hurdles in the way of business. So one area, we've talked about house builders there, and obviously at the moment, there isn't a lot of evidence of new volumes improving, new housing volumes.
So they're going the other way, aren't
It's
they?
going the other way. And I think even London, the level of affordable home construction is so lamentable that the new housing minister, Steve Reed's actually come along and said, look, okay, we will reduce the percentage of affordable housing requirement for new developments from 35% to 20%. And I think there's even talk among house builders that they can negotiate lower than 20, because as one of them said to me recently, 35% of zero is zero. That's the maths. And I think this is the problem. I think that we've had a government who's been out of power for a very, very long time. Labour are not used to the realities of elasticities, of incentives. And everything they've done in their first year seems to have been curbing the incentive for business to invest, curbing the incentives for individuals to go out and spend money because they're worried about the future, because they see their taxes going up. And so this loss of animal spirits is very real. It's a very strange thing because Simon will know better than me. Could you put an econometric model together to work out what characteristics do you need in order for animal spirits to flourish? By its nature, it's quite intangible. And I think that what we need to see from government now is a realization that incentives need to be put in place for investment to come through. Whether they can get there ideologically, I just don't know. And until they do, Jeremy, it's quite hard for me to go all in on cheap stocks because there just isn't a catalyst for these stocks to start performing.
I will resist the temptation to build an econometric model on the fly on a podcast. But what I will do is pick up on the point on the bond market, because the Chancellor, I think, understands the delicate balance that a government that owes, at least on balance sheet, £2.7 trillion to the bond market, and arguably a broader set of liabilities totaling closer to £9 trillion, including off-balance sheet items, has to recognise the views of its creditors and has to take those seriously, because otherwise they have choices and they can apply different prices depending on those choices that are made. What worries me, and I think worries a lot of investors looking at the UK, is what comes next if this Chancellor is replaced and the parliamentary party remain unchanged, i.e. we don't have another general election. Arguably a pivot further to the left with less knowledge and less understanding of that delicate balance, that delicate dance that needs to be done. Andy Burnham, who briefly flitted into view during the autumn, said we should stop being in hock to the bond market. The half-life on that comment was about 36 hours, and I thought was a sort of valuable and salient lesson. But the person who has got most momentum in UK politics right now, Zach Polanski, now leading the Greens, who are in quite a lot of polls, polling more than the governing Labour Party, is even more of the view that the bond market should just be totally ignored. And I think, one of the comments I get when speaking to investors almost at the end of every meeting at the moment is, we know that eventually the UK, being towards the very top of its tax take on a historical basis, highest since the mid-1940s, just 1.5 percentage points short of the level of public spending that required an IMF bailout in the mid-1970s. We're at some pretty extreme points. And therefore, at some point, that retrenchment has to happen. But what they struggle to get their head round is, where does the politics, the parliamentary cycle, the politics, the public, and let's also not let the public off the hook. We hold the politicians to account, but do we just get, as a result of our own views, we get the politicians we deserve? Because are we prepared to hear the truth about sluggish growth, sclerotic supply side, indebtedness to bond markets? Doesn't sound like we want to hear that question. So I think that line of sight to a retrenchment towards more stable macroeconomic variables, I think, is the thing that people struggle with to get fully on board with. I absolutely agree with you and have thought for a decade, UK assets remain very keenly valued, and there's the opportunity, but you do need a line of sight to better economic governance.
So if you look at the individual sectors, the one that probably feels most pertinent to this conversation at the moment is house building. And actually, the bite wasn't as bad as the bark. And so actually, it was fine. The mansion tax will affect a small number of properties, really, as a percentage of the total, mainly in London and the South East. So that's red meat for the backbenchers again, along with the child benefit on the other side. In terms of how things get moving, we've avoided the extreme sort of, obviously it'll take time to restructure the council tax, stamp duty, those sort of elements where, again, unlocking transaction volumes, it's the same with the equity market, which I know Jeremy feels quite strongly about. How can we generate more activity? And I think it may be a bridge too far at the moment for this government to say, if we cut taxes, we might generate more income. At the moment, my sense is, of course, they've got the OBR telling them what their expected impact of each tax measure they take. But it seems ideologically very difficult for this Labour Party to accept that they might actually propel growth by taking decisions which are perhaps contrary to their deeply held ideology. Could it be that a reform of stamp duty that actually led to more transactions could drive activity, not just in the housing market, but all the ancillary purchases that we make when we buy a house?
100%. I mean, look, it's a £64 billion question. That's how much tax revenue a year is raised through stamp duty and council tax. And frustratingly, the policy option of replacing it with a land value tax or a proportional property tax has been hiding in plain sight for at least 15 years since the Merleys Review, which is still the gold standard for UK tax reform. And it requires a degree of bravery. And by the way, the Tories ducked this for a decade, so let's not let them off the hook. But the idea of replacing a deeply regressive tax, which is what council tax is, and a tax that introduces a lot of friction to the housing market into the form of stamp duty, has exemplary growth characteristics. I can't think of an economist who would look at that policy and go, I'm not upgrading transaction volumes, overall growth, labour mobility, productivity off the back of that big change. Now, I get that the transition and the politics are really hard. It's always the case, the people who lose, and always in big reforms, there are losers and winners, and the losers complain more than the winners. But what are you going to do with a 150-seat majority at the start of a parliament? That's when you embrace these questions. And if you're true about it being your primary mission of growth, there's a whole suite of tax areas. Forget revenue raising or revenue cutting, just revenue neutral, replacing 64 billion over here with 64 billion over there on property taxes, income tax, the opportunity to roll together national insurance and income tax and get rid of some of those very perverse incentives around 50k and 100k. Capital taxes, a very Lawsonian reform of introducing an inflation indexation allowance into capital assets, but then raising the marginal rate of CGT. VAT, broadening what is the narrowest base in the world of value-added retail tax. All of these things are hiding there for a tax reforming chancellor with a big majority. She's been almost entirely silent on those, unfortunately.
What I'm hearing is that we're just going to muddle through. But to the point on the attractiveness of making UK assets more attractive to overseas capital, there's a few crumbs on the table, as I said, in the shape of some allowances on stamp duty for new issues. Now, we're sitting in a stockbroker's office whose livelihood depends on raising equity in the UK stock market. Does this make any difference?
It's necessary but not sufficient. So I first proposed this reform to the Treasury about 12 months ago, the idea of providing something of a more targeted tax environment for companies new to the market to have 3 years. I pitched 5 years, it came out of 3 years, to get round seeing investors, seeing people like Thomas, getting their story out. They're getting a track record on the public markets. That feels like a very sensible use of tax relief on stamp duty, but it's necessary but not sufficient to reinvigorate the UK market. I think two other things need to come into place. And one we've talked about already over the last 10-15 minutes, which is the supply side of the economy, reducing the inflation premium, getting growth going. The other part of it, and we've chatted about this, and I know there are differing views, and I think we have slightly differing views on the degree to which the UK pension system, which is a £3 trillion AUM industry, which is now effectively underweight its own domestic market.
The numbers are astonishing in comparison with other countries.
Yes, mandation is a dirty word, and it certainly is on social media whenever I raise it. But conditionality has a rich lineage of trying to incentivize people. You know, in the US, the Trump accounts launched over the summer, which is the equivalent to the junior ISA, incentivizes people by saying you can have the tax relief if you buy a S&P tracker. If you want to buy a Nikkei tracker or a FTSE tracker, you can't have the tax relief. In Australia, with franked dividends, again, hardwiring into the system an incentive to own your domestic assets to support your domestic cost of capital. We've moved away from that with the dividend tax credit being removed and then the stocks and shares ISA moving from the PEP model, which had an active incentive to own UK-listed instruments, to something that is geographically agnostic. I think the other part of completing the picture on a more healthy capital markets, as well as the growth picture, is looking again on the incentive structure in UK tax. And that doesn't mean spending more on tax relief. It's targeting it more appropriately for the domestic economy.
Thomas, any thoughts on that? What do you think? What more can be done here?
I'd love to see more IPOs. I think we've seen so many delistings and we're seeing a lot of share buybacks. So there is a period of intense de-equitization going on. One that's lurking there is Visma, which is the accounting business, which is based in Oslo, which is apparently looking quite seriously at London. So that will be a very good test, a business that people will warm to. Everything's incremental, isn't it, in capital markets? It won't be unhelpful that they've made this change. Whether it's enough on its own, let's hope that actually all these different reforms, the Austin Review, the various listing changes going on at the moment, it can't be unhelpful, but let's see. What we really need is that feeling of, the UK is a centre, again, a financial centre. I think, to be fair to Rachel Reeves, I've been quite critical, but I think that actually on financial services, she's obviously keen that the banks should talk her up. But actually, and I see Jamie Dimon came out today and said something very positive about her on Q. But look, she is doing some sensible things. They had a bit of a let-off, didn't they? They're setting up this new office in Canary Wharf. And he said he wouldn't do that unless he had this supportive government policy. And I've met the Director General of Financial Services in HM Government, and she was talking very positively about all the measures she's taking to promote growth. So it did feel very much a single-minded effort to promote growth in the financial services sector. I think we've got this wall of money in terms of DC money. We've got the tail end of DB schemes, but we've now got people taking ownership of their financial future. So they're going to need some help with that. And the nature of advice, who can access that advice, that's all going to be confirmed in the coming weeks. There will be a paper on that from the FCA. And I think that could be a really good opportunity. There's a lot of capital there that's currently, who knows how well served or underserved that is. I think looks like very underserved, that market. So how can Rachel Reeves help from the financial services industry to put that money to work?
So Thomas mentioned Visma. I think the specifics of the policy you mentioned, the listings relief for 3 years on stamp duty, is specifically targeted at Revolut and Monzo. And part of this story is also some fund managers who have recently retired described the UK stock market as the Jurassic Park stock market. And now that's not helpful for optics. The reality is, yes, we are overweight some lower growth businesses, but actually comments like that unfortunately mean that the diamonds that do sit within the UK listed market, high growth tech companies, get tarred with the same brush and on lower valuations. And therefore, the incentive to be bought out by private equity or move their country of listing just gets amplified. So part of this also is the optics of having higher growth companies that people know, young investors know, and Revolut and Monzo are two that they will know. And so I think this policy is designed specifically for those two companies. What, though, is frustrating, and it comes back to something I said 15 minutes ago, the one hand and the other hand not knowing what's going on, is the founder, of course, of Revolut has recently changed his jurisdiction out of the UK to the Middle East. Now, there's almost certainly lots going on there, but we are seeing enough anecdotes, aren't we, of high net worth founders leaving the UK because of a less favourable tax environment for founders, to make the one hand that is trying to incentivise these companies to raise equity capital and give UK pensioners exposure to those returns, but also then disincentivising them to actually found and grow and pay their taxes in the UK. And that feels so frustrating.
It does seem as though the only capital coming into the UK is to buy our distressed corporate assets that are listed or otherwise that are, maybe distressed is a strong word.
Not distressed, though. Good, depressed valuations.
Distressed, but priced as if they're distressed, but actually they're good quality assets. And that's the way our capital market is having to price itself off strategic and private equity coming into the UK and saying, I'll have that. And that, with share buybacks and wealthy billionaire founders of businesses deciding they want to go and live in Dubai, means that we're just a shrinking pond of capital that might have some great value in it, might offer some great yield attractions to, your income investor, but it's hardly dynamic. And it doesn't seem like we've got a solution for it.
Surely it's about broadening the base of potential buyers, because if you buy a position, you want to know there's someone to sell it at some point. And if we're narrowing the pool, that disincentivizes you to come in and take what is a very clear valuation opportunity on UK equities. You have to be confident that at some point you can exit that position. And that breadth of the investor base is crucial to a really healthy capital market.
Actually, when you look at the number of M&A takeouts there have been, you could argue it's actually surprisingly low. And I think activity in general has been low, both issuance, but also M&A takeouts. The level of takeouts is, if anything, I think slowed a bit in the last 6 or 12 months. Now, why is that? I would say the good point about yesterday's budget was we've got clarity. There won't be any March budget now. So we've got 12 months of potentially some rate cuts. I think you're predicting how many, Simon, in the 2 more in the next 12 months?
Probably in the next 3-4 months.
Okay, so that will be pro-growth. We've got the makings of stable policy. And so if you're thinking about the checklist of why you would not make investment decisions, one of them would be policy uncertainty. And I think that's helpfully now reducing at an elevated level, but it's not going up anymore. Yeah. So that's positive. And then on top of that, you've got this, how are we going to generate some growth, productivity growth? Someone's written about it at length, what can be done? And clearly what all of us around the table here would like to see would be pro-growth policies. We're seeing some individual pro-growth policies, which is better than none. And we've talked about financial services. There are some good things going on there. House building, there's some good things going on there. So it's not all bad. And is there enough of a gap between intrinsic value and the price at which a stock could be taken out? Yes, there probably still is. So we started talking about low valuations in the UK market. One of the ways I visualized it this morning, I heard, that the gap between investment grade credit and gilts is the lowest it's been for a very long time, for decades. I don't know if it's ever been lower than this. And clearly there's 2 elements there. There's that the UK government is seen as not a particularly good credit relative to history, but also that investment grade companies are good credits. And actually the economic outlook is weak, subdued, but it's not deep recession. And so actually that's fine. So then you take it to the next level with equities and you invert the PE ratio and you look at the earnings yield and it's somewhere between 7.5 and 8, 13 times earnings. That is a big gap. So if you go back to the activity levels that we need to see in capital markets, either takeouts, well, there's a big gap, isn't there? There's a big gap there, which is that if you can borrow at 4.5, if you're an investment grade company or a big PE firm, you've got access to all these bucket loads of capital and you're generating a nice, healthy, chunky earnings yield, cash flow yield, and you can still pay a 25, 30% premium. And there are lots of investors who would say, that's fine. Now, whether they should or not on a long-term view is a different question, but there's enough of a gap there for things to start happening. Now, on the other side, private equity companies are doing all these continuation vehicles. Why is that? Well, it's because they are struggling to IPO companies. So that needs to unlock as well. And cynically, I would also question at what valuation they're holding their investments in their books at. The conundrum is, how does that unlock? Because we would actually expect more companies to come in and take out our cheaply valued stocks unless they re-rate. Well, that's the opportunity for us. We just sit there and hopefully they re-rate organically through just solid execution. But if they don't, there's all this capital sitting there, dry powder, ready to invest. The conundrum is there something wrong with the valuations at which these PE firms are holding their investments? Because if that's the case, there's indigestion and there needs to be some sort of unlocking there. I'm sure that the people in corporate finance teams will help. It's about expectations. It's like selling a house. The vendor has high expectations because they love their home. The reality is, in this market, you have to be realistic. And similarly, we probably need to be realistic on our side of the fence too and say, look, actually, if we're buying in an IPO, we'd like there to be a premium on day one. Frankly, we've not been getting those. The impetus to take part in IPOs, given the experience that all of us on our side of the fence have had, with the lack of any follow-up from, you can see the green shoe. Frankly, it's embarrassing, some of these things. You look at the daily price moves and you can see the green shoe kicking in, which is this sort of buying by the investment bank to support the price in the early weeks. And then suddenly when the green shoe ends, quite often the share price just collapses. There just isn't that follow-on investment.
So that was a brilliant answer. But I sometimes worry in these podcasts where it's financial services talking to financial services and we don't tack it back to the real economy. So for those people who are listening to this, who might not be in financial services, and why is this relevant? I think it's really important to remind people what Thomas has just outlined really, really clearly is a competitive disadvantage for UK companies looking to scale, to grow, to be acquisitive, to be more productive, because they haven't got a continuum of capital, and some of them don't want to take private capital. Some of them don't want to take international capital. They want capital stack with options and the options that suit them. And if part of that, and if the public markets are not working well for them, then the type of growth that they want to achieve, they can execute, is closed off to them. And that means less productivity, less growth, less tax revenue, and that then means all the stuff that we value, potholes being filled in, doctor's appointments, become less affordable. I think it's sometimes the financial services sector does itself a bit of a disservice by not completing the picture between its role and the things that people outside financial services really, really value. And yes, of course, this industry still 17 years on has a marketing problem because of the global financial crisis and the banks. But there is always, and always has been, even in the dark days of 2009-10, a role for financial institutions to facilitate growth. And I think as an industry, we shouldn't just leave it to politicians. We've got to talk about that connection.
Just taking it to a more simplistic level, talking about the dynamics, you've painted a picture where there's less near-term concern around inflation. That's given scope for our monetary policy to take down rates reasonably significantly in the next 6 to 9 months. So we've got a 10-year yield, 4.4%, 4.5%, something like that. So we could see that heading down to 4, maybe below 4. What's the dividend yield on your fund at the moment, Thomas?
I've got 6% dividend yield.
That's quite an interesting dynamic. I mean, not investment advice, but you've got an investment grade portfolio of high quality listed UK assets yielding 6% in that environment.
I'm thinking this could be a big theme that is playing out. And the big theme here is that we've been conditioned in the last 10 years to believe that low rates would persist, and therefore a whole generation of fund managers grew up thinking they could just buy quality growth stocks. High valuations didn't matter particularly. You didn't have to worry too much about high valuations in an era of low rates, because the DCF model, of course, you're discounting £100 back in 10 years' time, and it equates to roughly £100. Suddenly, when rates go up 4%, 5%, you discount that £100 back, it's a lot less than £100. So I think that realization that cash flow here today is worth more, relatively speaking, than it was during the era of QE, that's only now becoming recognized by the wider market. And so with that, value is outperforming. And therefore, what's surprising people, I think, at the moment in the last 18 months, and I think this will continue to play out, is this belief in quality growth has become undermined. And so there's been a series of funds seeing significant outflows, net outflows, due to weak performance. And so, as you know, performance begets performance in this industry. People are selling their quality growth stocks. And actually what's happening is the likes of LSE, Sage, Relax, they're great companies. Nobody would deny they're great companies on a long-term view, but their valuations just went up too much. And then you've got this AI impact where nobody quite knows the impact AI will have on those companies. Going back to the 6% yield, Jeremy, what's exciting for me about the 6% yield is these are companies that are covering their dividends with cash flow. And so if I look at the median dividend yield in my portfolio, and then I look at the median free cash flow yield in the company, in the portfolio, it's about 50% higher, the free cash flow yield. So,
and your expected growth on that dividend?
It's about 4%, sort of high 3s, low 4s. So not stellar. The one area, when I look at my style analysis, which isn't as good as the wider market, is I'm slightly below on the growth characteristics. I monitor my portfolio on earnings revisions is better than average. Valuation is way better than average. It's way lower than average. And quality, actually, because we're buying stable companies with sensible balance sheets, net debt to EBITDA is much lower as well. So it's 1.1 times net debt to EBITDA. The average for the UK is 1.6. So I'm fine on quality. I'm fine on revisions. And I'm very good on value. Where I'm less strong is growth. But my contention is this is the whole point. This is the point I'm making about the post-QE world. We're in a world in which people are hardwired to believe you need growth for your share price to go up. What I'm saying is actually in a higher yield world, generate cash year after year, do your buyback, be disciplined on your capital utilization. Yes. You've got a decent total return from that. And it's not priced accordingly. And actually, if you want to go off and make big bets on AI, good luck to you, because I think the technology is changing so fast. I'd rather have the companies where I've got the visibility here and now.
And you're trading at a premium to NAV for the first time in a generation?
Yeah.
In living memory?
And actually, we look at the trusts in the UK that are trading at a premium, and actually quite a few of them have got a decent yield.
I think they're either very small cap focused or they're yield focused.
You've got to be differentiated. You've got to have good performance. Those are given. And then I think the yield is an interesting one where it's only dawning on people now that these cash generative businesses have had 20 years out of favour. Could this be their time? Now, things are always changing, so we need to stay flexible. And that links with the macro, and Simon's been very strong on this, that, you know, the idea that actually there are inflationary forces here which are helpful to certain traditional sectors. Banks, for example. Banks are benefiting. Wealth managers are benefiting. There are sectors where you could sit there and think, well, actually, they're sitting on this cash. And yes, rates will come down 2 or 3 times. They're still a lot higher than they were for that long sweep of QE.
So, fascinating discussion. Thank you very much. Can I just finish by asking you, Simon, about the way we do fiscal policy? I've accused you in the past of being a reformed policy wonk. How do we avoid the circus, as you described it earlier, that we've just been through, and with this sort of clown show event yesterday, not Rachel's event, but what the OBR did, or the mistakes that were made? Was it deliberate? I'm reminded this morning that you should never interpret what could be put down to incompetence as conspiracy. How do we get out of this mess?
Yeah. No, so I would abolish the OBR, the Office of Budget Responsibility, but you knew there's a but, because I'm an economist. You have to do it from a position of strength. You have to do it when the gilt market, which is the ultimate arbiter of your macroeconomic framework and your macroeconomic decisions, go, well, why? They don't need the OBI. They don't need them marking their homework because we think they're an excellent student, if you excuse the stretched metaphor. If you look at the benefits bill, the decisions over North Sea oil and gas, the decisions on the triple lock, some of the decisions on HS2, nuclear, Lower Thames Crossing. I'm picking on infrastructure projects where the cost of capital to lend to the government has to be a big number because they've shown themselves to be a poor custodian of your capital. Now, the OBR can be abolished when you show yourself to be a good custodian of capital and you're making grown-up decisions on the triple lock, on the appropriate level, because I started my career more than 20 years ago in DWP. You're always in a battle between the sort of societal changes on how benefits are claimed, how the system works. And this has got out of kilter with its long-term average. Are there signs of governments or politicians gripping this? No, they aren't. So the OBR is required as a signalling device. But you should be able to move away from that and reduce the circus and reduce the fact that, most MPs on both sides of the aisle really dislike the OBR quite intensely, including the current Chancellor, in my view, because they feel constrained for many of the reasons Thomas mentioned, which I don't think they do dynamic scoring particularly well in terms of understanding behavioural change. They don't understand incentives particularly well. But that doesn't make them unique amongst macroeconomic forecasters, but it makes them unnecessary, in my view, to have them as a judge, jury, and often forcer of an execution in terms of fiscal policy, but show, as politicians, that you're going to reform the tax code, that you're going to make the cost of infrastructure more competitive with other comparable geographies. We're not comparing the cost of capital of deploying public infrastructure in China and the UK. We're comparing it to France on high-speed rail. We're comparing with South Korea on nuclear power. Countries we can replicate, and we've chosen not to. The path out of this is to prove that you can be a really good custodian of public money. And then a lot of the doom loop associated with the OBR, associated with paying homage to the gilt market, or making decisions always with one or at least one eye on the gilt market, those can become secondary issues. My issues with the left of UK politics and UK economics, thinking we should just ignore the bond market, is show you can be trusted, and you can exactly do that.
Thank you so much, Thomas, Simon. I've really enjoyed this conversation. Thank you again for hosting it. It's a lovely surrounding, and hopefully we catch up again in the not too distant future.
Thank you, Jeremy.
Brought to you by Progressive Equity.